So I just want to give you the big picture of what I'm tracking, what the two most likely scenarios I see playing out into the rest of 2022 and 2023. Really two scenarios that I think are the most probable. The first one is in blue, and that is that June 16th was a major low, and this is the beginning of a new uptrend, which I would have targeting, let's see here, up into around the 55, 58 region. A lot of this would depend on what happens over the next the next, I would say, month and a half. And once, if the structure needed to justify this gets put into place, then we can start putting, targets in place. But just based off the information that we do have, this is the rough estimate of where I would see that. The other scenario is that this was the first leg in a larger bear market, and that we are in what I would say is finishing up the first of three legs in a very large bear market bounce, which I believe would probably top somewhere in late fall or early winter, and probably see a pretty bad start to 2023. And if this scenario is in play, keep in mind this is the A wave, and the C wave is always much more devastating. It's usually a lot more sharp. It's a lot more panic, a lot more volume, and tends to be at around 100% the length of the A wave. And we see this on all time frames going for, these corrective patterns from just, I've talked about it many times, go back to the 2000 top to the 2009 bottom. And that, that decade right there was a very large degree secular bear market corrective pattern, ABC, that was very proportional. So I would expect this to play out in the same way. You may ask me, well, how come this wouldn't be the top, the B wave right here? And the reason why I say that is if you go back and study these corrective patterns that happen on all time frames, the B wave tends to be the length and time of the A wave. So this is just too short for me. There is a corrective pattern called a zigzag, where you get 5 waves down, a very quick, short B wave, and then another 5 waves down. It's almost like the market is in a hurry to finish the correction. This would justify that pattern. However, this is not 5 waves down. So just from a probability standpoint, I find it hard to believe that this is what's playing out. If we do hit a new low, let's say that we just keep going down and break a new low, that tells me that something more bearish is playing out. And there would likely be a very large degree second wave corrective bounce up into these regions, which would give us a lot of time to prepare for what would follow. But these, to me, are the two most probable scenarios, and they're the two long-term bullish scenarios as well. And by long-term, I mean, is your time frame longer than a year to 2 years? And if so, then these are the patterns. These are the, this is just the price you pay sometimes in order to be a long-term investor. So anyway, moving forward, what needs to happen over the next couple months in order to help tilt the scales to either this red or this blue? And it is this right here. So I've been warning for quite a while to be cautious, because we only have 3 waves off the low. Our trend reversal is a 5-wave pattern, right? And we only have 3 waves. A corrective pattern is 3 waves, meaning that it's just a bounce within a larger trend. Okay, so I was warning that, the fact that we only have 3 waves off this low has complicated this scenario quite a lot. And this is also the reason why you saw us raising a lot of money and cash up in these regions right here. Yeah, we may miss a little bit of this upside, but I feel like we're going to have a lot better buying opportunities, either in early September or down in this region in probably late September, early October. So in order for the bullish scenario to play out, we need a 5th wave. It's really just that simple. And right now we have 4 waves in play. So we need to see some kind of a reversal and to make a new high. You talk about a hated rally that would be. I mean, I think everybody is pretty freaked out after today that we're just going straight down from here. But this is why this analysis is so important, is to provide proper context, right? And there's two things, well, three things I want to, actually four things I'll show you in terms of support zones. The first is this trend channel right here. And these are the angles this market is working off of. And as you can see, we've broken through these supports. It was holding this, but I'm going to have to look at the next fib level down. But breaking down below these trend channels is not the end of the world, but we want to see a pretty quick reversal early next week. The big thing was this, and these were the levels that we've been tracking for quite a while. Anybody that's been on these webinars, up in these regions, we were targeting, a move back to the 40-50 range to complete this fourth wave. And here we are. I don't like the fact that we broke below 40.75. As you can see with this trend channel right here, there's a really strong confluence of this trend channel as well as this support zone, and the market just sliced right through it today. It had a little bit of a bounce, but nothing of note, which tells me that we're likely moving down to the next fib level, which is really 410. But I'm giving this fourth wave to 4,000. I would even go as low as 3,975, but that would be a real big stretch. If we break below 4,000, the bull scenario that we could bottom here and turn back up into early September for one more high would be off the table. And we would likely be in a B wave scenario where we would be targeting 3,800. And that would need to hold 37.25. That would have to hold that. So if we do get the one more high, then that is a clear 5 waves off the low. It's something to celebrate, in my opinion. But this is not the place to buy. The place to buy would be on the second wave retrace. And keep in mind, this is not a clean 5-wave pattern. This is what you call a leading diagonal. It's very overlapping and messy, but we see them quite frequently as the first waves and new trends. And the thing about leading diagonals is there's not a lot of support zones on a retrace. And so we tend to get deep retraces. So once again, even if we do get one more high up in here, that's not the time to be buying. In our opinion, one way or the other. We think that whenever we get the second wave retrace, it's going to be the last great buying opportunity. Now, the game plan is, let's say that we just continue down and the leading diagonals off the table, and we are moving into the second leg of a bear market rally, of a large degree bear market rally. Then everyone's going to have to kind of determine what they want to do on their own. We would play this in a momentum fashion with a short-term time frame, because if this is playing out, we should get a C-wave rally probably up into the 4,500 region. These are all estimates until we can get some bottoming in place and a trend reversal. So we would play that, and when we start getting up in this region, you would see us warning everyone and getting quite bearish. And I imagine that the market would not be that way. If we get a reversal and a C-wave move, C-waves are 5-wave patterns. They tend to be, they're like third waves. They're very exciting. They tend to reverse sentiment and make everyone get a little bit of FOMO. So if that does play out, we would be riding that full force until we start getting to our target regions and into a major inflection zone where we'd start turning very bearish. So anyway, that's why the next couple weeks, next month is quite important. Really the next couple weeks, if we can turn up next week, get a new high into like early September in this time factor we're tracking, that is fantastic. That is something we would want. We'd be able to breathe a sigh of relief. So the next few weeks are very important, but just keep these levels in mind. One thing to talk about today, this was a big, this is what you call a railroad track right here. This was the third largest down day since this bear market started. And one thing I want to point out is it was on really low volume. This right here is a 162-day average of the volume. And the reason I did that is there's been 162 trading days within this bear market so far. And as you can see right here, this is a really low volume day for such a huge move. The other moves, like right here, was one of them. You can see it was well above the 162-day average. So just something to keep in mind. Usually when we see a major trend reversal, it happens on heavy volume, but instead we're getting these kind of divergences that are really worth noting. So lower volume, right? We're getting a divergence, a really strong divergence on the daily chart, which is rare. Whenever you see that kind of divergence, you can find it's really strong on every single chart, going lower and lower in time frame. And the way these divergences work, it's like dominoes. They eventually just all click at once. But this is a very strong divergence. This is one of my favorite newer oscillators that I've been using. It's really powerful for identifying support zones. This red zone right here was the exact same extreme that we saw in 2002. So it's a support zone that was, in the 2000 bear market. And as you can see, this market has used this zone to build future swings going back. And this green level is another level of support that was the same. You can see we've been building future past swings on the zone, and it was the 2018 low. So you tend to see this oscillator, when it's building a new uptrend, will bottom on like a historic low. It's really fascinating. So we're on a historic low. We're seeing a divergence, low volume sell off. So I would probably wouldn't be shocked if we move into the 4,000 region early next week and maybe see some kind of a reversal. I would love to see that. That's what we're hoping for.